American Indians are collecting more wood, so the winter is expected to be rough. Forecasters predicted that this will be a very cold winter. Looking at the forecast, tribals started collecting more wood. And looking at the tribals, the forecasters said that if they are collecting more wood, the winter is possibly going to be very, very cold. Hello everyone, welcome to yet another episode of Mind Over Markets. My name is Anand Vardarajan and with me as usual is Rahul Singh. Hi Rahul, how are markets treating you?
Hi Anand, how are you? Markets are very exciting and there's a lot of nervous energy before the D-Day.
Yeah, elections and market, I think interesting combination. Which brings me to my first question, Rahul, which is, a forward which I got from somewhere which read that American Indians are collecting more wood, so the winter is expected to be rough. Forecasters predicted that this will be a very cold winter. Looking at the forecast, tribals started collecting more wood. And looking at the tribals, the forecasters said that if they are collecting more wood, the winter is possibly going to be very, very cold. The corollary to this in a market sense is that pollsters predicted X party to be clear favorites. Markets started weakening a bit in the run-up to elections, and everyone started talking about party X not being as clear favorites because markets are correcting. And listening to that, markets have started correcting even more. So correlation is getting confused as causation, and somewhere it is a classic situation of the tail wagging the dog. So how does one make sense of all that is going around?
Yeah, it's interesting you say that because we don't know what is causing what, whether the voting percentages will actually lead to anything tangible on the result and therefore on the market, or whether the market volatility is causing the projections on the election results to change. It's very difficult to therefore make out the causation really. And also in the past, if you have seen that all the forecasts, sometimes they get the trend right, not the extent right. Sometimes they get the trend also wrong. So it's really very, very difficult to rely on any of these forecasts or rumored forecasts really. And I think the first real data point which we have to wait for is the exit polls, which will come out I think on the 1st of June. Before that, it's all speculation. It's very difficult to pay any attention to any of that which is going on. As fund managers, we are trying to stay away from that. As I mentioned, there is a bit of nervous energy leading up to the D-Day or the race day, but it's not really something which we are 100% acting on or necessarily being forced to act upon.
I think that every 5 years, what we've seen, Rahul, is election does have a tendency to cause this stomach churn in markets, if you will. And it becomes a catch-22 for investors because, this is a time where everyone develop cold feet in terms of, am I over-invested, under-invested? And it's a classic, jo khaye wo pachta hai, jo nahi khaye wo bhi pachta hai kind of a situation. So how does, I'm not saying from a very short-termish perspective, but how does one navigate this phase in terms of a binary approach of cash or fully invested does not work? But because these are such sharp turning point events that we have, which at least have material impact from a short-term perspective, if not medium to long-term, how does one navigate this?
Yeah, I think election always poses a certain amount of tail risks or a possibility of a black swan kind of an event. So to that extent, one has to be cognizant of that and not possibly be all in at that point of time, especially if the expectations are too high. And I think the way to navigate is at two levels. From an investor level, the asset allocation obviously is the prime, should be the prime focus, and that necessarily should not get driven only by elections but by the relative valuations between equity and debt, and I think we spoke about it last time. At the second level is where our role comes in as fund managers. And I think India as a market offers a lot of breadth in the sectors, including sectors which are not really dependent on election outcomes for them to do well as companies or sectors. So clearly, the more diversified we can be leading up to such events which can have tail risks is an important kind of objective. And I think given which scheme you are in, I mean, if it's a dynamic asset allocation fund, we really don't need to bother too much because we are anyway, relative to valuation of equities, we are at the lower end of the equity allocation. So if the investor level, I think if you can have a good mix of dynamic asset allocation fund going into such an event and a diversified equity fund along with your high risk funds, I think that should be the approach rather than trying to predict necessarily, because you cannot predict, but you can prepare for such events.
So how are we positioning our portfolios? Do we build up cash during this time? Where are we in terms of value growth tilt? How are we tilting our portfolio? So some color on that will really help.
Yeah, so we typically follow GARP, and the way we look at GARP is that which sectors or which companies are going to positively surprise on earnings going ahead in the next 12 to 24 months. And that's got not much to do with elections a lot of times. And therefore, we continue to stick with that as a basic. That's number one. Number two is that there are a lot of schemes where these are aggressive schemes by design or by mandate. There we need to be extra conscious of how much risk we are willing to take going into such an event. So in those kind of funds, we will probably take some risk off and may or may not look at cash as the only alternative, but we may look to take some risk off. But that's, probably minority of the funds. Majority of the funds which are fully diversified equity categories, where the sectoral distribution of weightages is very, very well spread out. We don't really need to be that cognizant of an event like this. As far as cash is concerned, again, it's linked to the answer. Depends on the scheme. If it's an aggressive scheme, an aggressively positioned scheme, you would probably be more willing to look at cash as an option rather than a fully diversified equity category or even dynamic asset allocation, because there anyway my equity allocation is at the lower end depending upon the valuation. So to answer your question, it's scheme specific. It is specific to how aggressive that scheme is by mandate and by design, and therefore how aggressively you should manage the risk going into such an event.
Understood. Any sectors which look interesting at this point in time?
Yes, I think starting with the sectors which have a lot of tailwinds, which is power, manufacturing and capital goods, they continue to look good. Valuations are becoming a question mark, but they continue to look good in terms of the fundamentals. The other sector which is looking good is the pharma and healthcare space, because that has not only got structural drivers of growth, but also cyclical drivers of growth in terms of the recovery in the US generic. So it's a good mix of structural and cyclical drivers, and valuations are not stretched. The third segment in this bucket is financials or large banks, specifically large banks, because a lot is in the price. A lot is baked into the valuations in terms of either the growth slowdown or the NIM pressure, and I think there could be potential minor surprises on both.
Okay, so thank you for sharing your views. I think that we've covered a lot of ground across markets, elections, sectors, and so on. So that's a wrap as far as this episode is concerned. Till we see you next time. Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.